A gentleman by the name of Donald Smith owns 9% of our company. He's a 77-year-old gentleman. He's got a $5 billion hedge fund in New York City. And he was trained by Benjamin Graham. Benjamin Graham trained Warren Buffett. He believes we're in a deep value cycle of the market right now. And the data point that I'd like to share is if you take the relative value of a basket of commodities, and again, relative to the S&P 500, a broad benchmark, the commodities have not been this cheap since 1970. So it's 2 standard deviations. So again, for value investing, this is certainly interesting. One of the challenges is how do you navigate these bad markets? So one of the unique situations or parts of our story that I'm going to try to drive home today is that we've been able to add value regardless of the commodity price so far. So there's 3 main points that I think are good takeaways for people hearing the story for the first time. One is that we're doing this again. The Santa Elena mine that First Majestic now owns was discovered, permitted, financed, built, and operated by our team. So SilverCrest 1.0, or SilverCrest Mines, was the original company. So we built that project on time and under budget, and we sold that asset in late 2015. This company started with an asset that we found during that time frame, took with us into the new company on a go forward. So social license and these conversations that we're hearing today are very, very important. We'll go more into that. So that's point number 1. Point number 2 is grade. That's a huge driver of why we're able to add value while the market's not doing so well. We have the 3rd highest grade primary silver project in the world, or the 2nd highest grade primary silver project in the Americas. We're also fortunate enough that our highest of grades is the first grade we're going to access as we get the project growing. That's going to be a huge driver for payback and economics. So that's number 2. The third part is the upside or the leverage you have to our drill bit as we find more ounces. So far we've only drilled for 3 years. And in mining terms, that's a very short period of time to have access to a property. Our first year, we only had 1 drill rig, no roads. We're pulling a man-portable rig up a hill to get the ball rolling, so we didn't get much done. Our drilling budget this year is going to be almost as much as the first 3 years combined. So far, I mean, Rosie's here. She's our VP of Exploration. She's done an amazing job. We don't let her out of Mexico very much. She lives down there. She's lived there for 10 years. Same house with the previous asset as this one. She's hitting on 70% of her drill holes, and our finding cost per ounce of silver is less than 30 cents. We're going to come up with an economic study in the next month or so, and most analysts, what they assume is that our margins per ounce are going to be north of $8 or $9. So if you can find an ounce for less than 30 cents, and your margins are $8+ at today's prices, that's a good driver of value. For every dollar we've spent, we've added about $10 of value. Not as good as the last presentation. I was like, but again, that's a huge driver in today's market. Also significant to that is that we're just on 10 of 30 veins, and everything's within 250 meters of the surface, and there's options for things at depth. So those are the top 3. We got the team that can do it, and the same team's in place. High grade, and again, we're still finding more. This is Eric. He's our CEO. He's a mining engineer and geologist. He's the one who discovered, permitted, and built the first one. Some basics on the property. Here we've got just under 40 million of cash, and that's Canadian pesos, I like to say. We talked about the high grade. We'll go more into that. And then the exploration upside. We'll kind of touch on that. Here's some basics to get out of the way. Again, you can see the cash balance there, significant. The share structure is quite important to us. We own 16% of the company, the management insiders. I did a lot of the finance work for this company in a previous life. I was in the brokerage business for 13 years, living in New York for 7. I was a big fan of Eric and the team, did all the financing, the M&A on the first asset, did all the seed rounds. So probably about 75% of our shareholders we can call within the hour. So Donald Smith, you can see he's up there. He owns 9%. He's an old client of mine. Gilder Gagnon owns about 6%, an old client of mine. 9 Point, RBC, those people are all on the list of clients of mine, so they're fairly happy right now. SSR Mining, they're about a $1.6 billion US company. In December, they took a strategic position in us of 9.9%. They've never made a strategic investment before, and they have an amazing track record of execution. They've exceeded or met or exceeded expectations for 7 years in a row. We'll get into more in the details there. You can also look into their performance versus the market. So again, it's one of the key points to drive home is that we think we're able to add significant value while the commodity price isn't exactly behaving the way we'd like. Mexico. We're in Sonora, Mexico. Very important to talk more about the ESG and the social license. So again, we've been here for 13 plus years. Eric, our CEO, he's a rancher. This is a ranching community. The largest political organization in the state is the Ranching Association. Sonora has a deal with the U.S. to export cattle, so that's a big reason why it matters. We just started up our own ranching business, so we've got 75 head of cattle right now, and that's so we can hire locals, be a part of the team, meet the community, have a say, be involved, hire people, and give them a good chance to participate. Also in Mexico, it's important to note, mining is the highest paying jobs in the country. There's an EBITDA royalty tax that the government put in place about 6 or 7 years ago. It's about 7.5% of the top line. All that money flowed to the federal government until about 1.5 years ago. And as of then, they started trickling down that money, some to the state level and some to the local level. So for us now, Arizpe, the local town we operate in, has an annual operating budget of $300,000. When we get to production, which we hope is the back half of 2021, we would add approximately $1 million to their annual operating budget, alongside of all the jobs that we would create. Also worthy of noting, there was another Mexican mining company, no locals or no Canadian companies, that had a big spill in 2014, and they didn't clean it up, and the water was contaminated. And in the first SilverCrest, Eric spent $50,000, which is a lot of money, but not a lot of money, to buy fresh drinking water for all the ranchers in the valley so their cattle could have clean drinking water during the time where the water was contaminated. So that social license is extremely important. An example of that is we had to amend a permit, something that in some areas can take years and years and years. It took us 4 weeks. You call the right people, and the right people know how you operate. They're going to be supportive of the work you do. It's worth noting here, the laser, that's the Santa Elena mine. That's about 25 kilometers away, trucking distance. That's the Mercedes mine, also within trucking distance. We just found this down the road by sitting on an old rancher's property for 2 years and cleaning up a family dispute. This mine used to be a producing mine. It was a producing mine from 1880 to 1930, produced approximately 100 million ounces of silver at an average grade of 1,700 grams a ton. So again, our grade today is 729, that's third highest in the world. This was more than double back in the day. In addition to that, they produced approximately 200,000 ounces of gold at 15 grams a ton. We have journals, diaries, technical reports. We've tracked down the great-great-grandkids who live in Lugano and Locarno, Switzerland. We have specimens that are in the Museum of Natural History. So the amount of detail we have and the advantage that's given us from a geological perspective is amazing. And that's not to take away credit for Rosie for finding the ounces we have. Talked about most of these details. I'll point out a couple, given the short time. We have over 200 drill intercepts over 1 kilo. So again, showing that the high grade's pervasive. And again, 50 drill intercepts over 5 kilos. Doing some metallurgy work, 98% recovery on the gold, 87 on silver. We're going to put out some updated metallurgical results in the next few weeks, just taking that to a higher degree of confidence, which is important. Important to note here, this is a new decline that we're building right now. We're about a month or so in, we're about 200 meters into that. I'll talk more about it. The highest grade we're going to access in the early initial years of production is what we're driving towards right now. We'll do some math on that. To give you a sense of how we've added value via the drill bit, it's important to note how we're moving on drilling. So last February was our first resource. We had 63 million ounces of silver equivalent, and I say that we're 50-50 silver gold. And that was 63 ounces at 500 and change grams. In September, we put out a resource that was just under 87 million ounces at a silver equivalent of 623. And then this year in February, we put out a resource that was combined 108 million ounces at 729. I'm going to show you a chart in a second, but I want you to remember the 87 at 623. So those grades and those ounces are in two distinct areas. This area here is 19 million ounces at 325 grams a ton. That's about 20th best in the world. We're going to ignore that for now. This area is where that decline's going into. We're engineering it to be the first, hopefully 7, 8, 9, 10 years of production. Once that area is depleted, we'll move over to this area, which is why we're going to ignore it for today. But that's 87 million ounces at a kilo. So again, in September, we were 87 at 623, and 6 months later, we're at 87 just in this area at a kilo. So again, that shows you the power of that drill bit. Also important to note here on where our next drill targets are. We can come back to some of that. But these areas here, when Rosie's being able to find ounces at less than 30 cents, this is where we're going to spend a big chunk of our time. I'm going to do some math just to get a feel for how to look at these companies and why the valuation of our company and the payback period is potentially as robust as it is. So if you take this grade, that's roughly a kilo, that's 1,000. If you divide that by 31.1, that's how you convert grams to ounces. And if you get that number, and then you take $15, that's below today's silver price, but pretty close, and then you multiply it by the number of tons, that's how you get the value per ton. What's the gross value per ton? If you do that math, you'll see that this 42 million ounces in this area is worth over $600 million US. Our market cap today is about $300 million US. If you were then going to subtract the operating costs to actually extract it, and that's not included in the mill and whatnot, just the operating costs, about $100 a ton, you're getting to about 450 million of value just in this area. And then you take an even smaller subset of that, and right here you'll see that it's 375,000 tons. So the size of the mill that we hope to build is 1,250 tons per day. So we're going to build a mill that's pretty small, but it's going to hopefully have a high amount of production. On an annual basis, that would require about 430,000 tons. So we have 4.6 million tons today, so that's about 10 years of mine life as it sits. But this is less than 1 year's throughput. It's 8% of the total amount of tons that we have. But if we do that same math again, and you take 1.75 kilos, divide it by 31.1 to get ounces, multiply that by $15 an ounce, and then you multiply it by the tons, this area alone is $315 million of gross value. And if you take off that operating cost, it's about $280 million of recoverable value just in an area that's 8% of our tons. And that green box right there, that's where that decline is going. So the tunnel that we're building right now is going to be ready to go in June. We hope to start production in the back half of 2021. So that means we have 2 years to develop the underground, access not only this ore, but the 87 million ounces in the area, and have probably or close to our first year of production fully stockpiled on the ground by the time we start the mill. That's very unique in mining to have that much upfront development and that much of a head start in a risky part of the operation. It's also relevant how we might finance this operation. If you're a bank and you're going to do project financing, they'll do reserve-based lending. So they're going to want to see approximately 2 times the amount of value in reserves per dollar lent. So I think most people assume that our CapEx is in the neighborhood of $120 million. If you look at roughly 100 million of debt, or 70, we're not sure how we're going to do it just yet. Again, if you go back to 280 million as the gross value, it shows you that we don't need to be diluting ourselves significantly to get there. With our recoveries, the way that they're looking right now, with the way of us getting our first year of throughput ready to go, the risks of going from an exploration development to a producer, they're still there. It's mining. Let's not kid ourselves. But they're significantly mitigated in that time. Other veins that we can do the same math with, I'll leave it to you for that point. This shows you the asset in a different direction here. So that's that decline we had that photo of. That decline to get to that high-grade area is going to cost us about $2 million. If we push that out to get to this area, in that whole area is probably about 5. So if you add up all the costs for us to access that, it's probably less than $15 or $20 million. So again, when you go into having the capital required versus the payback period, this is a very significant part of our story. Some of the high grade here that we can kind of look at, it's a little hard to see. We have presentations outside, but just to get a flavor for, if 729 grams a ton is the third highest in the world, this gives you a flavor for some of our better ones that we're going to be working on. This is in the Museum of Natural History in New York. This is an exhibit from 1880 to 1930 that was taken out. So if you're in New York next time, it's worth checking out. Catalysts, how to look at the story in the near term. What we're working on right now is the preliminary economic assessment. What that is where you lay out how much is this going to cost? How much are we going to produce on an annual basis? What are the costs per ounce? What's the payback period? Most of the analysts assume that we're going to have an IRR, an internal rate of return, sort of like your annual return on a project, of over 50% at today's prices. That's relevant because about 50% of the industry is losing money at today's prices. So it goes back to that idea of time. We don't know when that commodity market's going to turn, but we can actually add value while we wait. After we put out that economic assessment, in Q1 next year, Q2 next year, first half, we're going to put out a full feasibility study. That's driving that even further. Again, most analysts assume that right now we're going to be able to produce north of 10 million ounces in our first 5 or 6 years for less than about $6 an ounce. So again, we'll see what the economic study says, but that's looking like about $8 or $9 margins at today's pricing. So again, if you assumed roughly 100 million or 120 million of CapEx, if you're about 10 million ounces a year and you're roughly 8, 9, 10 million of margin, again, we'll see what the studies say and we'll see how we execute. But it gives you a flavor for a payback period that has the chance of being less than 2 years. So again, small amount of capital and a quick payback period, again, which is unique in the industry. Drilling. We're going to be doing a lot more drilling. Rosie's got 13 drill rigs turning. Half of them are going to be to tighten up that drill spacing so we can reduce the risk and increase the confidence of what we have. But the rest of it's going to be going after new veins. So again, everything we have so far is within 300 meters of surface. There is a whole nother zone at depth. And if that's the case, it takes the 30 veins that we have, and we have the chance of that being double. And remember that only 10 of the 30 veins that we have today are in the resource. So still significant leverage to the drill bit during that time. Permitting, for us, again, going back to the social license and the strong community relations, we've applied for all our permits. We're just waiting for a change of use of soil. And again, this is an old disturbed mine site, so again, just getting that permit is the last one that we require, and that would be a significant de-risking event. Not totally under control per se, but we're hoping that's in the back half of this year. Some ways to look at value. So again, we're 300 million US market cap. So that in over 100 million ounces, so that's less than $3 an ounce, assuming we don't find any more. And if your margins are 8, 9, 10, depending on today's pricing, that's one way to look at it. Free cash flow. Again, we're not in production just yet, but if you have those margins and they're looking like the first few years are north of 10 million ounces a year, significant free cash flow. One of the metrics worth noting is SSR Mining, the company that owns 10% of us, or you can look at the whole industry. There's not much free cash flow today. So one of the other catalysts that's worth noting is we have the chance of being an interesting takeout target. For people that don't have a strong balance sheet, they could use debt to put us into production, pay back that debt within a year or two, and then the free cash flow that this asset could generate could help them move forward with other assets, pay back other debt that they have. So again, M&A is a huge part of this industry. It's been in the headlines for quite some time, and it hasn't really materialized. So for us, we're happy to move the asset forward. We're happy to put it in production. The team that did it before is what we still have in place. If someone wants to make us a bid, we'll definitely show it to our shareholders. And at the same time, we'd like to find a lot more ounces. So we've got a fair amount of brokerage coverage as well. So again, there's plenty of research out there to share. And here's the charts, just showing where our grade is in terms of the rest of the world. And then there's the sort of 20th in the world. So that area that I sort of ignored is still almost making it in in the top 20. And there's where we are in the Americas. So thank you very much. I appreciate your time.